This is your Swap Hunt Daily News for February 26th, 2026. Morgan Stanley is making its biggest push yet into Bitcoin, and institutional ETF inflows have finally broken a 5-week losing streak. Markets are holding in neutral territory today, but sentiment tells a more uncomfortable story. The Fear and Greed Index sits deep in extreme fear, near its lowest reading in months. The total crypto market cap edged lower over the past 24 hours with broad weakness across major assets. Bitcoin pulled back from a recent high set earlier this week, and altcoins continue to lag. The backdrop is cautious, but institutional positioning is shifting in a way that's worth watching closely. Morgan Stanley is making a serious move into Bitcoin. According to reporting from the block, the bank is exploring direct Bitcoin trading, yield-generating products, and custody services for its E-Trade retail clients. This is a significant escalation from a firm that has historically maintained a cautious distance from digital assets. The scope here matters. Trading, yield, and custody together represent the full stack of Bitcoin financial services. Morgan Stanley wouldn't be building out all three simultaneously unless it viewed this as a meaningful long-term business line. E-Trade has tens of millions of retail brokerage accounts. Bringing Bitcoin access directly into that platform would give an enormous number of mainstream investors a regulated, familiar way to hold and trade the asset without needing a crypto-native exchange. The yield component is particularly notable. As staking and lending products face regulatory scrutiny elsewhere, Morgan Stanley exploring yield on Bitcoin suggests confidence that a clear legal framework is close enough to plan around. This move follows a broader trend of traditional financial institutions no longer treating crypto as a reputational liability. JP Morgan, Goldman Sachs, and Fidelity have all expanded digital asset offerings in recent months. Morgan Stanley moving this decisively signals that the institutional window is no longer cracking open, it's swinging wide. After 5 consecutive weeks of outflows, Bitcoin spot ETFs have recorded their first week of positive inflows. The return of institutional capital into the ETF wrapper is a meaningful shift in market structure. During the prior 5-week outflow streak, roughly $3.8 billion left these products, the longest exit period since spot ETFs launched in 2024. This week's inflows represent a reversal, even if the magnitude is modest relative to the scale of prior exits. What's significant isn't just the number, it's the timing. The inflows arrived as Bitcoin touched its highest level in several weeks before pulling back, suggesting that some institutional buyers are treating the current level as an entry opportunity rather than a reason to wait. BlackRock's IBIT has been among the more active products this week according to on-chain flow trackers. Analysts at several firms have pointed out that sustained ETF inflows historically correlate with upward price pressure over weeks, not days. 1 week does not make a trend, but the end of a 5-week outflow streak is a data point that changes the narrative heading into the weekend. The question now is whether this is a genuine rotation back into the asset class or a brief pause in the broader institutional retreat. Binance is back in front of U.S. lawmakers. The Senate is now formally inquiring into alleged sanctions violations totaling $1.7 billion tied to the exchange. This comes despite Binance's November 2023 settlement with the Department of Justice, in which the exchange paid $4.3 billion in penalties and its former CEO Changpeng Zhao pleaded guilty to money laundering charges. The new Senate inquiry focuses on whether Binance facilitated transactions connected to sanctioned entities and jurisdictions even after that settlement was reached. According to the inquiry documents reviewed by Cointelegraph, U.S. senators are asking for full disclosure of compliance records, transaction logs, and communications related to the identified period. Binance has publicly stated its sanctions exposure declined 97% since 2024, a figure it highlighted in a recent transparency report. But lawmakers appear unconvinced that the internal compliance overhaul has been sufficient. The broader implication here is that for Binance, regulatory rehabilitation is an ongoing process rather than a resolved chapter. For the wider industry, the inquiry is a reminder that exchanges with complex histories face sustained political scrutiny regardless of prior settlements. Any formal findings could trigger additional penalties or restrictions on Binance's U.S.-adjacent operations. On-chain investigator ZachXBT has published a detailed exposé alleging coordinated insider trading on the Axiom launchpad platform. According to ZachXBT's findings, a network of wallets with apparent advanced knowledge of token listings accumulated positions immediately before public announcements, then exited into retail buying pressure. The pattern is textbook front-running. Wallets linked to the scheme reportedly rotated funds through multiple addresses to obscure the origin, a technique that has become increasingly detectable as on-chain analytics tools improve. ZachXBT identified specific transactions, wallet clusters, and timing patterns that he argues demonstrate systematic exploitation of non-public information about which tokens would be featured or promoted on the platform. Axiom has not publicly responded to the allegations as of this reporting. The broader context matters here. Launchpads have become a significant entry point for retail participation in new tokens, which makes insider trading on these platforms particularly damaging to market confidence. If insiders are positioning ahead of retail, the deck is stacked from the moment a token is announced. ZachXBT's track record lends credibility to the claims he has previously exposed similar schemes on multiple platforms that later led to regulatory or community action. This is the kind of expose that tends to trigger rapid fund movements and platform audits in the days that follow. Friday's White House Crypto Summit is shaping up to be one of the most consequential policy moments for the digital asset industry in years. The event brings together top crypto executives, regulators, and White House officials to discuss the framework for U.S. crypto regulation going forward. Running parallel to the summit, the Clarity Act is advancing in Congress. The bill is designed to resolve one of the industry's most persistent legal headaches, determining whether a digital asset is a security or a commodity and which regulator, the SEC or CFTC, has jurisdiction. The absence of clarity on this question has created legal uncertainty that has pushed several major projects and exchanges to operate cautiously or relocate offshore. The Clarity Act would establish a defined process for tokens to transition from SEC oversight to CFTC jurisdiction once a blockchain network reaches a sufficient level of decentralization. Supporters argue this creates a workable path forward. Critics say the decentralization threshold is subjective and difficult to enforce. What makes Friday significant is the combination of executive engagement and legislative momentum happening simultaneously. The crypto industry has waited years for this kind of coordinated policy attention. Whether the summit produces concrete commitments or remains symbolic will likely determine how markets interpret the outcome heading into the weekend. Vitalik Buterin has published what he's calling the Strawmap, a 4-year development roadmap for Ethereum stretching through 2029. The document outlines the major technical milestones the Ethereum Foundation intends to pursue across scalability, privacy, and protocol simplification. On scalability, the roadmap prioritizes continued rollup support and blob throughput increases following last year's Pectra upgrade. The goal is to make Ethereum's Layer 2 ecosystem dramatically cheaper and faster for end users without sacrificing decentralization at the base layer. Privacy is a notable addition to the formal roadmap. Buterin has written about privacy repeatedly in recent months, and the Strawmap elevates it to a first-class priority, including potential native privacy features at the protocol level, not just at the application layer. Protocol simplification is perhaps the most technically ambitious piece. The roadmap calls for reducing the complexity of Ethereum's consensus and execution layers, which have grown considerably since the merge. A simpler protocol is easier to audit, harder to attack, and more accessible to new developers. The Strawmap is a signal of long-term institutional confidence in Ethereum's direction. For developers building on the network, it provides a planning horizon. For investors and ecosystem participants, it frames the next 4 years as a period of focused execution rather than directional uncertainty. That's your daily crypto roundup for February 26th. If this kept you informed, subscribe to SwapHunt HQ here on YouTube and follow SwapHunt on X for real-time market alerts. See you tomorrow.